Good afternoon, everyone, and welcome to today's wealthmanagement.com webinar, the ETF Imperative, Where They Fit Now in Your Client Portfolios, sponsored by iShares from BlackRock. My name is Mark Bruno, and I am the Managing Director of Wealth Management at Informa Connect, and I will be your host today. In a moment, I'll be introducing all of our speakers and talking a little bit more about the specific areas of focus that we'll get into during today's discussion, which is incredibly timely. And the Fed meeting right now, hopefully we do actually get to break some news about where interest rates are heading in the next couple of moments here. But just to give a little bit of background on some of the functionality in your webinar platform here, you can customize it, so feel free to move the windows around by dragging on the title bars, resizing them so you can see our panelists, so you can see the PowerPoints, and you're obviously comfortable and able to access a lot of the materials that we have available for all of you here today. A copy of the slide presentation is actually available for download on the resource list widget, which is on the bottom corner of the webinar console. Another note, this webinar has been accepted for 1 CE credit towards the AEP designation program, and the live broadcast of this event has also been approved for 1 CFP board CE credit hour. The Investments and Wealth Institute has accepted this program for 1 hour of CE credits towards the CIMA, CPWA, CIMC, and RMA certifications. Also, just a final housekeeping note here, we do welcome everyone's questions, and if you do have anything that you'd like to ask any of our panelists, please feel free to use the Q&A tab that is also on the webinar platform as well. We'll try to get to as many questions as we possibly can during the hour that we have here today. So now let me introduce today's speakers. We have an amazing panel here for this Wealth Management Edge Visionaries webinar. Delighted to have Michael Lane, who's the head of iShares U.S. Wealth Advisory business and a member of the U.S. Wealth Advisory and U.S. iShares Executive Committees at BlackRock. Michael, thank you very much for being here today. Also thrilled to have Craig Lazzara, Managing Director in the Core Product Management Group at S&P Dow Jones Indices. Thank you, Craig, for being here as well. And also thrilled to have a friend, financial advisor Vance Barse, wealth strategist and founder of Your Dedicated Fiduciary. Vance, thank you for being here today as well. Now, with that, let me give a little bit more context about today's discussion and why we're specifically having this conversation around ETFs today. As many of you know, the markets, the economy have gone through some incredible changes and challenges, which we'll start talking about in just a moment. 2022 is really a banner year for a number of reasons, and I cannot remember a more complex market or economic environment. With that, we'll talk about market conditions, but we'll also talk about portfolio construction. As many of you who are here today know, the same approach that you've been applying to client portfolios for the last 10 years or so of bull markets is not going to work, or is not currently working as well in today's environment. So we'll talk about portfolio construction strategies. We'll also talk about some new asset allocation approaches, and more specifically, we'll get into investment products and solutions. With a very heavy emphasis on ETFs and different ways that you can incorporate them into your clients' portfolios to better align them with your clients' goals and needs. So with that, before I ask all of our speakers to just give their opening remarks, I would like everybody just to do a very quick intro of their role, their organization, and specifically how you all are working with the financial advisors, or in the case of Vance, how you're also working with your clients and what your focus is at your dedicated fiduciary. So with that, Michael, if you wouldn't mind just starting by giving us an overview of your role at iShares and BlackRock, please.
Sure. Thanks a lot, Mark. It's great to be here. And great to be here with Craig and Vance as well. So I'm Michael Lane. I head up our iShares for Wealth business. So that means that I am involved in all things iShares, and as well as BlackRock, in the wealth management business. So I work with the people in product development, as well as the operations, marketing, everything is, and with the goal of providing the right solution at the right time for financial advisors as they're working through portfolio construction, as well as helping financial advisors build models if they're a models-based practice.
Excellent, Michael. Thank you very much. And Craig, a little bit about your role at S&P Dow Jones Indices, please.
Great, thank you. And Mark, thanks to you, and thanks to all of you for being with us. My name is Craig Lazzara. I have the privilege of being a managing director in what we call core product management at S&P Dow Jones Indices. For those of you who don't know, S&P Dow Jones Indices is the largest index provider in the world. We license a product to BlackRock and other ETF providers as well. My role in the firm is really twofold. One is to be an advocate for indexing generally, as people consider whether they should be in indexed assets or more active portfolio structures. And the second is to provide particular support for what we call our factor indices, those indices that aim to deliver a particular pattern of returns that investors find congenial. And I'm delighted to have the chance to talk about both those things with you today.
Excellent. Thank you very much, Craig. I appreciate it. And Vance, a little bit about your background and your dedicated fiduciary, please.
Yes, thank you very much, Mark. First, I wanted to share that the Fed raised rates by another 0.75 percentage point, so everyone heard it here first.
Breaking news.
It's a pleasure to be here and on the panel. Thank you very much for having me, Mark. I founded your dedicated fiduciary almost a decade ago after spending a decade consulting and teaching financial advisors nationwide on how to invest portfolios for high net worth and ultra high net worth families. We have approximately 60 families coast to coast for whom we serve as in-house fiduciary for all aspects of investing and planning, which includes tax and estate planning and so forth. And it is truly an honor to be here.
Wonderful. Thank you all for sharing a little bit of background. I know you're familiar with many of the names and companies that are here, but that additional context really does drive home just how much thought leadership, influence, and impact our panel has on the broader wealth management and asset management industry here. So with that, let's just jump right in. Michael, I would love to get your take. We talked a couple of months ago about markets and how 2022 is shaping up, but I'd love to just contextualize for a moment before we go a little bit deeper here into portfolio construction and also investment solutions that are now available to advisors. 2022 has presented advisors and investors with one of the most challenging market environments in U.S. history. So maybe you could start by contextualizing some of the most significant short and long-term changes, as well as where you see some heightened risks and opportunities. Michael?
Sure. Great. Well, thank you, Mark. It has been quite the year. We thought 2020 was going to be quite the year. We had a big dip and a bounce back quickly. 2021 was a strong market performance year. And if we look at 2022 from a market perspective, I've been in this business for 35 years, and I'm hard pressed to see, an environment when I think back over those 35 years that would resemble this. You have to go back, I think, a little further into the late 70s to see the type of market environment that we're in today. I mean, just some of the statistics. At the close of business on the first day of this year, the S&P 500 was around 4,800. Right now, I look at my ticker and it's at 3845. So we're down almost 25% year to date on the S&P. Nasdaq, which we know is very tech heavy, started the year at 15,833. Right now, when I'm looking at my numbers, it's 11,384, which means we're down 40% from the beginning of the year. In the S&P, down 25, Nasdaq down 40. So it is a very rough start to the year from an equity perspective, but that only tells half the story. You look at fixed income, and I was asking somebody recently, what do you think the 1 year was when we started the year, the 1 year Treasury? And people had different answers, but it was 40 basis points, 0.4%. Today, I haven't looked at it this last second, but when I looked at it yesterday at the close of business, the 1 year was trading over 4%, up 370 basis points in these 9 months. And you look at the 10 year, it's more than doubled from 160 basis points to over 350 basis points. Even the 30 years, up from 2% to 3.5%, up 150 basis points. And when you think about the impact that has on fixed income in a portfolio for an individual, when you think about duration, a simple duration times rate change, what that impacts the portfolio, it's significant. On a 10-year, if you had a 10-year duration of your portfolio, not looking at just a 10-year bond, but if you had a 10-year duration of that portfolio, and you have a change of 175 to 200 basis points, you're talking about 20% loss in that portfolio of fixed income for principal value, just a simple duration times interest rate movement. So that is the impact we've had. So we are in, I can't say it's unprecedented territory because we have seen things like this before in the 70s. I think even in 1974, I may be wrong on this, but I think in 1974, we had almost a 50% intra-year move in market prices, plus rapid inflation increases, plus rising rates. So we aren't in unprecedented territory, but we are definitely facing something that we have not faced in 50 years. And most financial advisors, except our most experienced, very most experienced, have probably not experienced this in their lifetime as a financial advisor. And so there's a lot of questions. What do I do? How do I do things differently with portfolios? Do I stay the course? You know, what's the right move? And so we have that with markets, and what's driving some of that? Well, we've got the Ukraine-Russian conflict, which we're all familiar with at this point. We have issues with, supply in the oil sector, and that is also connected to Russia, and fertilizer, which creates food issues in terms of food famine, and that creates inflationary prices on food. You have water shortages in some areas that haven't had those in a long time, and then we have flooding in other areas, extreme flooding. So whether you want to call that climate change or not, there's definitely changes to the climate in certain areas. And so that is definitely impacting. And the climate changes every year. It changes every decade. But we are definitely seeing impacts and risks associated with those changes to our climate in terms of droughts, fires, floods. And so that is impacting the world, and that's impacting, of course, the biggest word we're using these days is inflation, which, as Vance just said, is 75 basis point rate increase. Why? Because we're trying to tame inflation. We're trying to tame people from buying and borrowing so that supplies can catch up with demand. It's a very supply-driven inflationary environment we're in right now. So we're trying to harness that. The good news is, with all of that, we are seeing energy prices come back down. I live in Austin, Texas. I drove by a gas station yesterday and saw gas under $3 a gallon again. Great news. Great to see energy prices coming back to earth. That's a fantastic point. In fact, if you look at the entire country, the average energy for gasoline price at the beginning of this year was $3.67. Actually, that was about a year ago. It was $3.67. Today, the average across the entire United States is it was $3.20 1 year ago. It's $3.67 today. So that's that's up 15%, but still we're coming back to earth a little bit when you look at year over year, even on energy prices, much better than we're looking at. In some areas, we're getting $5, $6, $7 a gallon for gas. So we're definitely coming back. And the last thing I'd say is we definitely have a political problem right now. We are getting more and more extreme, and we need to be the United States, and we need to bring people together. We're not doing that very well right now, and that's causing other conflicts. And so it is a very interesting environment, market-wise, what's happening globally, what's happening domestically. And so there's a lot of consternation, a lot of concern about how do I serve my client best? How do I manage money for my client best? The goals haven't changed, but how I get to that goal definitely has changed in today's environment. But there are bright spots. There are areas. The thing I love about America is every challenge is an opportunity. I mean, when you think about it, if we can work through some of the things that we have to work through in terms of our immigration policies and how we bring more labor into the United States so that we have the ability to, harness inflation, because if we bring more supply chains onto the United States soil, what do we know? The more supply chains we have here, probably the higher price of labor, which means prices are going to go up. So we have to bring more labor that's willing to work for a certain price point into the United States. And so we have to also have a better immigration policy. So all of those things are heightened risks, market issues, but we are opportunistic. We are America. We will work through this. And I do believe that as we continue to get through the period of time we're in, and we do bring supply chains on, overall, bringing more labor in, producing more here, increases tax revenue, increases infrastructure, where innovation is going to continue to increase. Innovation is going to make things more efficient. We're going to continue to improve the way that we extract and consume energy, and we're going to continue to create new innovations for new energy additions that are going to supplement our energy. And so a lot is happening in the United States. I feel very good about where we are going in the future, but we have had a very rough start to 2022. So hopefully that sets not a too gloomy context, but we are seeing glimmers of hope in certain areas as we look forward.
Appreciate that, Michael. And while it may be a bear equity market, I think in our last conversation we talked about how this could actually be the beginning of a bull market for financial advice and wealth management. I think people need professional guidance more than ever before, especially the only other sort of macro trend I would add is that given the number of people who are actually retired right now, who are clients of financial advisors, right? They're not in accumulation or growth mode, right? There's a lot more that goes into the decumulation side of things, which we'll get into in detail in just a few moments. With that, Craig, I do want to come to you because I think Michael gave some amazing context and really put what is a remarkable 2022 in perspective. I would like to understand what all of that has meant for money management, more specifically returns that you're seeing more broadly. I know you just very recently launched some new research that talks a little bit about active management and the returns we've seen in 2022. So Craig, please take it away and walk us through your SPIVA results.
Yeah, no, thank you. I'm happy to do that. Let me try to step back just for a moment and give a little context. When the ETF business began in 1993 in the U.S., it was entirely a passive business. In other words, the first ETFs were wrappers around index funds. And as I said in my introduction, obviously S&P Dow Jones Industries has a keen interest in the history of and the application of indexation. So I want to give you a little bit of context as to why index funds or passive investment generally are important, and why what results have supported that sort of assertion. And so to do that, I want to talk a little bit about the research that we've done and others have done around the subject of the active versus passive debate. Now, although we maintain data, and I'll mention in a moment, on an up-to-date basis, the earliest study of which I'm aware that asked the question, how did the average active manager do versus a passive alternative, is 90 years old. There were studies done in the 1930s. There were many studies done, a lot of academic work in the late 60s and early 70s, all of which suggested that the average active manager underperformed a passive benchmark that was appropriate to his investment style. Now, S&P Dow Jones has taken up that torch, if I can call it that, and has continued this strand of research with a set of reports that we call SPIVA. SPIVA stands for S&P Index versus Active. And what the SPIVA reports do is to look at a survivorship bias-free database. That's important, by the way. It's hard to say, but it's important. Survivorship bias-free database of mutual funds, and ask the question, how do actively managed funds do in comparison with benchmarks that are appropriate for their investment style? We just released, literally less than a week ago, a SPIVA report for the U.S. for the first half of 2022. And those are the results we're looking at now. So in the first half of 2022, January through June, 1% of all large cap mutual funds in the U.S., actively managed large cap funds, underperformed the S&P 500. 54% of all mid-cap funds underperformed the S&P mid-cap 400. 63% underperformed of the small-cap funds underperformed the S&P small-cap 600. If you pull the report off our website, you see there's a lot more detail than this. We go into growth versus growth and value versus value. The story is very much the same. This first 6 months was not a bad period for active managers relative to the historical past. If you look, for example, back 5 years or 20 years, regardless of the cap scale, what you see is that the performance histories or the performance challenges is much more acute. For the last 20 years, only 95% of large cap funds have underperformed the S&P 500. Similar results for mid and small cap. This is simply a look at the year by year percentages. You can see, some years the majority of managers outperform, some years not. In fact, there have been 3 years in the last 20, now 21 and a half rather, in which the average large cap managers outperformed the S&P 500. The most recent was in 2009. So it as a general rule, the majority of managers underperform a benchmark that's appropriate to their style. Now, people often ask, well, it may be true that the majority of managers underperform, That doesn't mean that there aren't some managers who consistently outperform, and that is absolutely correct. It doesn't necessarily mean that. So in order to examine that possibility, we do a companion report to SPIVA that's called the Persistence Scorecard, and we're looking at results from Persistence Scorecard now. There are many ways to skin the persistence cat, but the idea is to say, let's go back in time, pick an above average group of managers, and see how did they do in a subsequent period of time. So what we're looking at here is based on 10 years of data. 10 years ended in December 2021. We take the first 5 years of those of data and say, let's identify all of the large cap managers and all the mid, all the small cap managers who were above average, or the top half of the distribution in the first 5 years. And then ask the question, how did they do in the second 5 years? And the answer is shown here. If performance were completely random, you would expect 50% of the above average managers from the first half also to be above average in the second half. And what you see is the results are somewhat less good than that for large cap and a good bit less good than that for mid cap and small cap. What that means is simply that when you find a manager who has done better than average historically, statistically that doesn't tell you anything at all about the likelihood of his being above average going forward. So let me summarize for now, just by two observations or two summary observations, and then an assertion that we can come back to in question time if there's interest. The observations are these. First of all, most active managers underperform most of the time, and secondly, that past success does not predict future success. The assertion, which I'm happy to discuss at length for those who care to, is that these observations are not coincidental. It's not like there was a cosmic coin flip 100 years ago and the active managers asked for heads and God flipped tails. This is not a coincidence. These things happen for very good reasons. The reasons continue to be in place, and therefore the observations, I would suggest, will continue in the future as well. So thank you.
Craig, thank you for that. There is a tremendous amount of food for thought there, no question. And I appreciate your context as well. Vance, I'd like to bring it to the practitioner perspective here too, and get your take. With all of these massive changes, the challenges, the risks, the difficulty finding traditional sources of return, how have you responded, and how much has it influenced the way you're specifically working with your clients and the types of recommendations that you're making now?
Well, first, I wanted to thank Michael for painting the reality that we face this year in 2022, and also Craig for sharing the data. I'm a very data-driven person, and I always tell families that data should drive $related decisions. We've all heard that in real estate, it's about location, location, location. And this year, folks, it is about inflation, inflation, inflation. It is coming up in every single conversation. And ultimately, clients want to know one thing. Am I at risk of outliving my assets? And so from that question, we really look at how to modify the portfolios in the transition into 2022 and how to react to and navigate the anticipated inflationary environment through which we have been going year to date. And this has been a reminder that stock markets do in fact go down. And the real reality check this year has been the ballast of the portfolio, which historically has been fixed income. A lot of folks have their bond allocation satisfied through bond mutual funds. And Michael shared the interest rate environment and really how rapid that rate of change has been over the last 6 or so months. And we can now manifest the allocation in ways that we were unable to do as of 6 months or 12 months ago. So when it comes to the equity portion of the allocation, a lot of clients understand why having companies that are brick and mortar companies, great balance sheet, positive cash flow, and really these moat type companies becomes very important, and why it's key to understand the selection when it comes to fixed income, really to help navigate the rising interest rate environment. It was shared earlier that many of today's advisors and investors have never actually been through an inflationary environment. And it seems largely to have come out of nowhere. things that come up in conversation on a routine basis. China, when is China going to up again? The Ukrainian situation, when will that subside? And ultimately, how long will it take for things to normalize back to, say, October, November, December of 2021, really before we had these big spikes in inflation? From a planning standpoint, Mark, it really opens up conversations on how we can employ certain tax-related and estate planning strategies that have presented themselves. And let me clarify, we're not CPAs here, and we're not estate planning attorneys, but many of the strategies that we advise families to implement have estate and tax planning implications. And it's so important for fellow financial advisors all around the country to maximize this opportunity to bring the utmost value to clients because of the environment that we are in.
Thank you, Vince. I appreciate that. And I do want to spend a little bit of time taking everything that we've talked about, but applying it to what's actually happening in terms of portfolio construction, maybe shifts in asset allocation, and also the types of investment products and vehicles that are being used right now. So, Michael, I'd like to bring it back to you. You have tremendous visibility into flows, and also just talking with a number of financial advisors, qualitatively getting a sense for where money is moving, right? I am curious, Michael, maybe you give us a little bit of context. What are you seeing now in terms of shifts in asset classes, sectors, and also investment products? More specifically, how are ETFs fitting into the mix right now as well?
Sure. Thanks, Mark. Last week I had the good fortune of sitting with 5 of our very different contributors to our active business. I head up the iShares wealth business, but I was sitting with the active component, partners who are running different active strategies for BlackRock, and hearing their take on what's happening in the markets. I speak to advisors. My goal is to speak to several advisors every single week, just to keep in touch with what's happening and what are they doing. And I've also spoken to our, we always talk about the whole portfolio at BlackRock. It's not just about individual components, it's about the whole portfolio. So I spoke even this morning with Michael Gates about how is he looking at the whole portfolio, because he is someone that's heavily followed by financial advisors in terms of the models that he builds, and they learn from that, and many track what he does. And so I asked these different parties, what are you seeing? What are you doing? What's different right now versus even at the beginning of the year with, when we looked through those numbers we talked about earlier? And a couple insights that I gleaned from all of them. First of all, what sort of kept many portfolios afloat for the last 12 months have been commodities. Commodities have done very well. Yields have been very high. Energy prices obviously spiked. And energy companies, as well as other commodity prices, this spikes. The returns of those were significant. We see that trimming as we head further into recessionary environments. Europe definitely heading to a recession. In a recession, probably going to be a deep one in Europe. In the U.S., maybe we can stay out of it. Maybe be shallow. Hard to say at this point. But we see commodity prices as demand continues to shrink during a recession. We see commodities being something that people are loosening up on. That was a big component of certain portfolios for the last 12 months. We see that starting to trim. When we talk about the European recession, that's going to be likely very deep. We see advisors reducing their exposure to European equities, to European securities. So we see that happening in portfolios. And even though when we talk about, and we talked about earlier, how the NASDAQ, which is a heavy tech component, when we see that down 40%, you would think, well, maybe now's the time to jump into tech and growth. We don't see it. You talk to the portfolio managers, you talk to our active managers, you talk to our portfolio managers, they're not seeing it. They're not jumping in. And so that's one of the things we're also hearing is this is not the time to say, okay, I'm going heavy in, because if we do head further into recession, consumer spending declines, there's going to be an impact on the technology sector. And so that may not be over. So we do see more money shifting from our PMs into value strategies. And so the advisors who have held on to value, probably a good idea, continue to hold on. And then we go to the fixed income side. And the fixed income side is as we talked about with, some of these yields rising 300-400 basis points, in 9 months. fixed income is an interesting one. We still see people staying and continuing to move shorter and shorter on the curve. And even when you listen to somebody like a Rick Reeder, heavily regarded from the portfolio industry, he's really looking at that short end saying, if I can get 4% in 1 year, why would I go long right now when we still have uncertainty about where rates will head even after today's 75 basis point move? So I think you're seeing on the fixed income side, you're seeing a continued move to shortening duration for anybody who has had duration. That's been painful this year. And we're seeing a continuation for people using anything that might be inflation protected. So we're seeing a lot of short tipped, like a STIP, a short tip type portfolio. So those are some of the high, very high level changes that we're seeing, whether it be European securities, commodities, duration on fixed income. We're seeing those types of moves. Obviously, when it comes to ETFs and where do ETFs fit inside of all that, when you think about the uncertainty that we are facing heading into 2020, the end of 2022 and going into 2023, where it's very hard to say anybody would be willing to predict what's going to happen with any degree of certainty. I think there's a lot of uncertainty. What we do know is that the focus and the focal point for the advisors that I'm speaking with on a day-to-day basis is on what you can control. We can't control the markets. We can't control what's going to happen in the next 4 months or the next year or the next 2 years. We know there's a lot of uncertainty in the world. But in environments like this, when we're trying to add value to our clients, when that's the primary purpose of our relationship with a client is to add value, help them achieve goals. The other big one, try to reduce taxes. So where I do see the ETF fitting beautifully into an environment like this is the typical liquidity that we see that, every time there's a stress to liquidity, and whether it's the treasury market or credit or any other market, ETFs have always been that price discovery tool, and we'll continue to see them used for that purpose. So liquidity is obviously a big one, but tax is the other. And as we enter into this, fourth quarter of this year, there is going to be there should be an increased emphasis of financial advisors focusing on reducing the tax liability of the client by making sure you're avoiding the capital gain distributions from the mutual funds that you may own, and transitioning those, which we've seen hundreds of billions of dollars transitioning over the last several years, transitioning that to something where you don't have to worry as much. You still should be paying attention because not all ETFs don't pay capital gains. It's not a given. But even if you look at our core strategies, they haven't paid a capital gain distribution for the last decade. So there are strategies that you could move money into to reduce your tax liability, both annually as well as while you're doing that this year in almost every asset class, fixed income and equity, which again, you go back to the 70s, really before, the last time you could do this, you can tax loss harvest. I call it the gift that keeps on giving, because if you don't have any gains this year, that's okay. Use it in the future. But you can tax loss harvest, avoid the capital gain that may be paid from an active mutual fund, reposition the portfolio to be more resilient for the uncertainties that we're facing. And now, not just this year did you add tremendous value to your client to reduce the tax bite, but next year, possibly the year after, possibly if markets start to come back, now you have this opportunity where you can sell those winners in the future and use these losses that you harvested this year to offset that. So you can reduce your tax bite in the future, potentially. Talk to a tax advisor. As Vance said, he's not one. I'm not one either. This is just what we know happens in the, is going on right now. So that to me is we've got portfolio construction moves, but we also have this tax opportunity across the entire portfolio that if I was sitting across from consumers still like I did, earlier in my career, that's the thing that I would be focusing on a lot is how do I cut their tax bill today and into the future?
Well, and what you mentioned, Michael, just about focusing on what you can control, I think is an important takeaway. There are so many things we cannot predict, so many things we cannot control, but your emphasis, your guidance is around the tax loss harvesting is an excellent point. That's just a reminder for our audience too. If anybody does have specific questions, please feel free to use the Q&A tab here. We're happy to try to get to as many of the questions as we possibly can in the remaining time. And, Vance, I just want to come to you quickly. As you hear Michael kind of talk about money in motion and also some of the more sort of practical applications here, right? Controlling what you can control. How does that sit with you? And quite literally, what are you doing right now that might be different in this environment from what you may have been doing in your previous years with your clients?
Everything that Michael shared resonates with me, and I know that the camera wasn't on, but I was literally giving him a standing ovation because the time to act and bring value is now. You might actually have to cut me off, so I have a few thoughts to share, and I don't want to overstay my welcome with respect to time. So when we have a family on board, one of the very first things that we do is convert from the average cost basis, which is what's listed on most statements, to the ID cost basis or the tax lot specific cost basis. So a very common example, Mark, is when a family comes on board, they'll have a taxable account, 5 to 25 different actively managed mutual funds, and they appear on the statement to be up in value, which is great. However, when we actually open the hood on that investment and we can see that the capital gains, the dividends, and the interest distributions have been reinvested at the prior firm, or maybe they were self-directed, each one of those has its own tax lot and its own cost basis. So the original purchase, say 2010, might be up significantly. The subsequent annual capital gain, dividends, and interest reinvestments might be down at a loss, particularly over the last 2 to 4 years, given what happened in markets in 2020 and this year. And it allows us the opportunity to go in and select very specific tax lots to sell. And we have to be very careful, as Michael mentioned, because of capital gain distributions. And one of the other things that we'll do is switch from the reinvestment of the capital gains distributions to take those as cash, because we have to be very careful with respect to wash sales. And I can't emphasize that enough. So there's a lot of time that goes into reviewing this. But I'll explain to clients, if we have investment A, and investment A is a mutual fund, and the historical data relative to the actively managed fund versus its passive ETF equivalent shows that historically it's been more optimal to capture that return stream in an exchange traded fund. I will show the clients the underlying holdings in the mutual fund, find an ETF equivalent, and explain it's not that we're getting out of this because it's bad. What we're wanting to do is take this allocation and reduce not only the cost of the investment, the expense ratio, if you will, but also help with the tax efficiency. Because when I look over at the Schedule D on the tax return, I'm often able to see the capital gains tax drag that a client wouldn't otherwise see. And I can show that by selling the tax lots that are down, and depending on the given tax profile in a specific year, maybe offsetting those lost sales with equal and offsetting gain sales, we're able to tax efficiently create oftentimes a very substantial amount of liquidity to roll from a higher cost tax inefficient vehicle to a much lower cost tax efficient vehicle. And we can do that all on the same day so that the client doesn't have to be out of the market waiting for trades and sales and so forth, pardon me. So it's a very opportunistic time right now because of what markets have done year to date to go in and look at those specific tax lots. And one of three things: either if the client is in a lower than average tax bracket this year, we might actually do tax gain harvesting. If it's a standard year with respect to the tax return profile, we might do tax loss harvesting and offset the losses with equal and offsetting gains, really to tax efficiently create as much liquidity as possible. Or in the third scenario, if the client has a higher than average tax year, maybe we really want to create as much of a loss as possible and only sell the tax lots that are down. And perhaps they have charitable intent, which is also evident on the tax return or that comes out in conversation. And you might remember that tax lot that I mentioned from 2010. If it's up 400, 500, or 600%, we can use that highly appreciated tax lot to satisfy charitable intent, either by journaling that directly to a charity or possibly implementing a donor advised fund or another similar type of charitable strategy. So this is a really great environment to take what has been historically an expensive tax inefficient portfolio, keep the same allocation, but use this as an opportunity to reduce the cost and increase the tax efficiency.
Yeah, I appreciate that, Vance, because I mean, really what it comes down to, you're talking about now, that's the value of advice, right? The value proposition that of a financial advisor right now, and how that is changing. And I personally believe it's a great opportunity for for your peers to establish themselves as being more important, more critical than ever before. So thank you for going deep on that one particular sort of approach or strategy there. I do want to bring it back to yeah, please, Michael.
I was going to ask you, I was going to make one point to it. Vance brings up a lot of great points on that. And one of the hardest things to do is to really systematize what Vance was just saying and make that a systematic approach. And that is where, there are two tools that I have to put out there that people should take a look at. They're on, the BlackRock Advisor Center, but one is the tax tool where you can put a portfolio in and it'll track the performance, the price return, the capital gain that's going to be distributed if it has a capital gain that's coming out, how many days you have to sell prior to that. It systematizes all of that. So I think that that's really important. And something that Vance said too, which was really important, is wash sale rules are complex. And so you have to be very careful not to, you want to maintain your exposure, but you want to take the tax loss. And so you want to loss harvest and buy something that's close. But if you buy something that's exactly the same, materially exactly the same, then you actually diminish it or reduce or eliminate that loss that you took. So there's also on that same site is a tool called the correlation calculator, where you can go in and it'll tell you how many securities in common, what's the correlation, so you can find something that doesn't have the same securities in it but might have a highly correlated return, so you could maintain your exposure and have a higher probability of avoiding that wash sale. So I think those are critical for listeners to know that they exist as we're talking about what could be an unprecedented time. Even when you think about price return of fixed income, you might have bought fixed income 10 years ago, and the price return, because total return, don't look at that because that includes dividends. Your price return might be at a loss, even if you bought something 10 years ago in the fixed income space because of what the marketplace we're in today. So really important to look at the price return and systematize that for clients.
I appreciate you bringing that up. You had mentioned when we were talking earlier, and I did not know that those tools existed either. Great asset, very efficient for our audience to use. So thank you for the reminder on that. I appreciate it, Michael. Craig, I did want to come back to you because, we've talked quite a bit about, obviously, the markets, portfolio construction, use of ETFs, and some tax strategies here. But I did want to talk a little bit about, especially if we're looking at, potentially going into a recession in 2023, more advisors thinking about building defensive portfolios. We don't know everything that there is to know, but we do know that there will likely be more volatility in the market, right? So if advisors are thinking about constructing more defensive portfolios, you recently authored a blog post on the relationship between defensive strategies and volatility. Can you talk about that a little bit? Because I thought it was really enlightening and really important for our audience to understand.
Yeah, thank you. I'm happy to do that. I would, if I can add something to the tax discussion, which is purely speculative, but nonetheless, I think true. We have an election coming up in less than 2 months. Depending on the results, it may look like taxes are going to increase next year, or perhaps not. I will motives to either party. I'll just say that there are some outcomes that would make federal tax increases more likely, and some that would make it less. And that's obviously something we'll all be looking at in terms of making judgments about what to do at year end. The question, Mark, that you asked is a very relevant one. And what we're seeing, if you look at performance in our index families and interest and flows to ETFs, is this has been quite obviously, I'm not saying anything anyone doesn't know, this has been a great year for defensive strategies. So if you ask the question, which of our index families have done the best this year, the answer is value, dividend-oriented strategies, and low volatility strategies. But more generally, what we've done in a recent paper, which called it Defense Beyond Bonds, and then some blog posts around it, was to look at defensive strategies in maybe a more holistic way. And what I mean by that specifically is we're often asked which equity strategies do particularly well when interest rates rise. And that's obviously a very relevant question today because interest rates have risen. Again, today they rose and have risen a lot so far this year, as Mark pointed out. what we've done in this chart, it's a little complicated, so let me explain. We've separated all the months in our database, going back, I think, 27 years of data, and said, let me separate those in terms of months when the S&P 500 was up. Those are the months at the top, and then at the bottom, months when the S&P 500 was down. On the left side are months when Treasury yields, 10-year Treasury was down, and on the right, months when the 10-year Treasury was up. The important thing to notice about this chart is that if you look at any of these four scenarios, horizontally they look alike. Vertically they look different. What I mean by that is, if the S&P 500 is up, historically, growth tends to outperform, low volatility and dividend strategies tend to underperform. Those are the scenarios at the top. If you look at scenarios when the S&P 500 is down, growth tends to underperform, and the best performers tend to be low volatility and dividend-oriented strategies. If you sort by the behavior of the bond market, it turns out not to matter very much, because historically, at least in the period for which we have data, when bond rates have gone up, when the Treasury market Treasury yields have gone up and bonds have gone down, the S&P 500 has gone up more often than not. So we're in a relatively unusual environment now. We're in, if you locate it on this chart, in the lower right, where 500 has been down and Treasury yields have gone up. And we like to summarize what defensive strategies do for you in this kind of environment. I sometimes use the phrase the two Ps, protection and participation. What that means is that strategies like low vol, dividend aristocrats, low volatility, high dividend, things like that, minimum volatility, things like that, tend to go down less when the market declines, so they protect you to some degree in declining markets. And the price of that defensive benefit is they go up less when the market goes up. Now, if you take that on board, let me show you an example of one of these strategies, low volatility. I picked that one because it's very simple to explain. It's the 100 least volatile stocks in the S&P 500. What we're looking at here is two efficient frontiers, both based on historical data. The blue line represents combinations of the S&P 500 and bonds. Would you call that gold? I suppose the gold line, maybe it's yellow, who knows. The gold line represents combinations of the S&P 500 low volatility index with bonds. Technically, in technical terms, the gold line dominates, meaning it lies above the blue line. What that means is, if you use a defensive strategy, I mean, low volatility is perhaps the best example, but is by no means the only one. Value would fit into this category. Low volatility, high dividend, minimum volatility, many other indices fit into this category. If you use that approach, rather than using the S&P 500 as your equity vehicle, you can achieve both higher return and lower risk, while in many cases reducing your overall bond exposure. And many advisors find that an attractive feature, especially now, because if bonds are no longer serving the defensive function they have served for much of the last 30 years, it behooves us to think about ways we might achieve a more defensive outcome while still minimizing our fixed income holding, and using defensive strategies gives us a way to do that.
Excellent. Craig, thank you for adding your perspective there. I thought, when I read the blog post and saw your two Ps, I felt like it was an important part of this conversation to touch on, especially with some of the changes in strategy that a lot of our listeners are considering here today. So we have just about a little over 10 minutes. If anybody does have specific questions, please feel free to drop them in the Q&A tab, and I will steer them to our presenters. And I do have, Michael, a question that I wanted to bring to you specifically. We talked a little bit earlier before the webinar about this concept of risk and risk management in the retail or the wealth management world. 20 plus years ago, when I was a journalist, I was covering institutional investing. talked to a lot of defined benefit pension plans, and they were moving in the direction of embracing, liability-driven investment strategies. We touched on that a bit, and it seems like with as many of the financial advisors, clients right now that are in retirement, the more clients that are in retirement, the more the role of an advisor becomes almost like a personal risk manager. So on the subject of LDI, are you actually seeing this applied now at the individual investor level? It sounds like there's some movement there. And if you are, what role does the prevalence of ETFs play in an advisor's ability to construct those types of portfolios?
Sure. And before I answer that, I'll just also note I love the information that Craig was just sharing. And if listeners go to my LinkedIn page, you'll see a post I did with Lucas Smart that also, in addition to Craig's blog, there's a paper he wrote on minimum volatility strategies. And so that's something that we've been talking a lot about as well. So 100% on board with Craig's comments. So your question about this liability-driven investment, very institutional-driven, it's how defined benefit plans were supposed to be managed. If they were accurately managed to that, we probably would have a lot higher funding ratios, but there's always this desire to go for more and to manage for total returns, and sometimes that doesn't work out, because if you go for more, you can also end up with less, and that's what has happened in a lot of these. And so, LDI, liability-driven investment, it's something, I'm shooting this series now. We just shot the first 2 episodes called Hey Dad, where my kids ask me questions about investments and things they want to buy. And these are actual, not scripted, just us having a conversation, with a big film crew sitting there recording our conversations. And so it's an entertaining way to teach your kids about investing when you're being filmed doing it. But you think about the conversation I'm having with them. People think LDI is very complex. Well, it starts with, a simple question which is, what's the purpose of the money? And so every time one of my children would suggest, I want to go, I want to invest, I want to buy stocks, I want to do X, I always come back to, so what's the purpose of the money? And if depending upon the purpose of the money, that means you have a different liability. And so a liability could be saving for a car. It could be saving for a home. It could be saving for education. It could be saving for retirement. Now, when you buy a car or a home, obviously those are point in time savings, because you need the money to buy the car, or you need the money to put a down payment on the house. When you save for education, it has to last for a certain number of years. Some kids, it's 4 years. Some, it might be 10 years. So it has to last. And you have to kind of know what you're shooting for from an educational perspective. My kids are all 4 years apart, and they're all in school at the same time. I didn't think that would be possible, but they're all in school at the same time. And then you've got saving for retirement, which is probably the longest duration of a savings. And it'll take you the longest to save for it, and it has to last the longest. And so once you understand the purpose of the money, you invest differently. And one of the challenges I think we all have, Vance, as a financial advisor, Craig and I, Mark, all of us as educating investors, is the Zs and the millennials, which are my children, or Zs and millennials, especially the younger millennials, they have spent a lot of time in, being exposed to what I would call more speculative investments. And I hate to even use those two words together, but more speculative items versus investments. And that's what they've known. And if you just buy those to try to get more, well, that's a challenge. There are lots of examples in speculative investments that are down 80, 90+%, 100, 99% over the last 12 months in that speculative space. And so LDI, the basic premise of it, which I see more and more advisors, it's becoming very prevalent, start with the purpose, start with the goals, understand the price of those goals, and the price of those goals change. The price of those goals change by different factors. It could be interest rates, it could be longevity. There's lots of different reasons that they change. And then manage first, think about it, and this is where ETFs play a great role. What type of risks do you need to take to achieve that? And how do I de-risk it? And if you think about saving for a car, if you need $20,000, as soon as you have $20,000, you should have it in cash, or very, very, very short-term instruments, because you need the money to go buy the car. That is a very different savings plan and LDI strategy than saving for retirement, where it has to last, let's say, 40 years. It's going to take you 30 years or 40 years to save for it. And when you think about how much risk you have to take, that's why people, when they're younger and even in their 30s and 40s, take lots of risk, and that's okay to save for retirement, because you can't afford to retire if you didn't take any risk that day. Whereas in these shorter term liabilities, the way you invest for those is different. So we definitely see this taking more hold in the advisor space, talking to clients, not just going for total return. Like that is something that a lot still, are just focused on. Investors are focused on total return. But I love this liability driven investment structure that, is not new. DB plans have used it for years, but a lot of the DB plans, the reason people think DB didn't work, it did work. It's just, you have to be careful. Every time you go for more, when you're fully funded and you can achieve your goal, you have a probability that you're going to end up with less. So when you can achieve your goal, de-risk your goal, and you have to understand how to de-risk. And ETFs make it easier because you have such precise instruments. Credit, duration, particularly in fixed income, it just makes it easier to apply the appropriate credit and duration to those liabilities.
Yeah. Can I add something?
Yeah,
Michael,
please,
can I add something? That's very well stated. And it reminds me of something we often say about defensive strategies, which is there's a real difference between the way institutions and individuals regard market downturns. I mean, let's suppose the market's down 20% or so this year. I mean, today looks pretty good, but market's down 20% or so this year. Let's suppose, something really badly goes wrong. It's going to go down another 30% before it bottoms several years from now. If I'm, the CalPERS pension fund or the Harvard Endowment or some large institution, that just created a buying opportunity. I mean, I can reinvest my dividends at lower prices over the long run. I've got a multi-decade horizon. I don't mind that the market went down. I might even like it because I can lock in better prices. If you're planning to retire next year, it's a completely different thing. And so, to the degree that, and all of us, individuals and the clients of the advisors on our call, all of us are mortal individuals. We all have limited time horizons. We may not like to think about it, but we know it's true. And that means that the closer you get to retirement or to any goal, but let's take retirement, the more important these defensive strategies potentially become, because your ability to recover from a downturn in the market is much less when your time to invest is much less.
Thank you for adding that, Craig. I appreciate it. And just to quickly touch on a question that somebody in the audience had, LDI stands for liability-driven investments. At a very complex level, it could be an asset to liability matching strategy. I love the way, Michael, you described it, is basically just asking the question, what is the purpose of the money? And I'm very much looking forward to your first episode of Hey Dad, where I can go inside the minds of your kids and understand what they think the purpose of the money is. We do just have a couple of minutes left, so I want to make sure we go to each one of our panelists for a closing thought. And Vance, I'll start with you. I know we've covered quite a bit here. It's hard not to, given the year and the environment that we're operating in, and so many variables turning the corner and heading into 2023. That said, for our listeners that are here today, what would you say is just your one key takeaway as they're starting to think about ways that they should potentially adjust client portfolios, or really think about the role and the problems that they're solving for their clients? Your final thoughts.
Pardon me. It's really important to understand the tax return profile and how to take advantage of the disadvantageous market we've had this year to really leverage that as a means to achieve a much more lower cost and tax efficient. And also, it's really important to understand the financial planning strategies that have presented themselves resulting from this market.
Vance, thank you very much for that. I appreciate it. And then Craig, I do want to come back to you. I know we've covered a lot. You did an amazing job just categorizing the performance at the very beginning of active management relative to more passive. Also walking us through your relationship between your thoughts on defensive strategies and volatility. Any closing thoughts or a final key takeaway for our audience here before we conclude?
I guess two things I would say. One is that in the decision of whether to use actively managed funds or factor or defensive indices, Obviously, individuals will have different takes on this, but those who choose active funds should realize the odds are against them. That's the first thing. The second thing is that for clients who want or need defensive strategies, there are more alternatives now than simply shifting from equities to bonds. There are many defensive strategies that can be applied and delivered through the ETF wrapper, and they're very much worth your attention.
Wonderful. And then, Michael, we will give you the final word here. You've covered quite a bit as well. But is there anything that you would leave as a final key takeaway for our audience here as they're rethinking and coming up with different ways to solve for some of their clients' problems and challenges?
Sure. And I saw one of the questions was about ESG and, should the whole portfolio be ESG? And, the answer that I would give to your question satisfies that answer as well. Is every investment decision is an individual decision. Some people invest for values and what matters to them and what's their purpose and how do they want to align their investments with things that are important to them. And others are interested in maximizing returns. And it's not, they segregate their, let's call it values from their investments. And so everybody's different. And that is one of the things that I stress that I love about iShares and BlackRock is our job is to provide choice. Our job is we have 400 different iShares that you could invest in. And not everyone is going to use any of, some of those. Like most won't use 350 of those. They'll use a few of them and they'll be perfect for building a portfolio. So I'm a huge believer that choice is what our job is to provide the building blocks and the choice. And then it's a financial advisor and the end client that have to make the decision of how they want to invest, where they want to invest, how they want to build a portfolio. And we're here to help you make those decisions and assist you with data. But at the end of the day, that's a consumer and a financial advisor's decision. And it's not a BlackRock decision on how people actually manage their client wealth.
I think that is a perfect way to conclude here. So thank you, Michael, Craig, and Vance for spending the hour here and educating our audience. And in the end, this is one of the most important webinars I think we've done this year because there's still, on the subject of tax planning, tax loss harvesting, there's still time to really be thoughtful and strategic and think about ways that you can add and create value for your clients. So Michael, Craig, Vance, thank you for offering some thoughts that are very, very practical and also for recommending some tools that our audience can use to do that more effectively and more efficiently. On behalf of the entire wealth management team, I just want to thank everybody for joining us here today. If you joined late or if you wanted to recommend this webinar to a colleague, we have recorded this. It will be archived on wealthmanagement.com and it will be made available on demand for the next 12 months. So if you'd like to, again, wealthmanagement.com, you can access a replay at any time of this webinar here today. Thank you again to our panel. Thank you to the iShares team for sponsoring this. And thank you to everybody for tuning in here this afternoon. On behalf of Informa and the Wealth Management Group here, I'm Mark Bruno. We appreciate you all tuning in. Looking forward to seeing you all on our very next webinar. Take care, everyone.